Last August, the United States government told you oil would average $51 this year. It averaged 92. This morning, Saudi refinery is burning. American oil tanks just hit the lowest level since 1984, and the smart money is still betting the price goes down. Somebody is lying to you. Tonight, I'm going to prove it with their own paperwork, and I've got the dates. I'm Sean Pruitt. I don't trade oil on a screen. I own it in the ground. 30 years, and I'm recording this on a phone out in the middle of nowhere because that's where this week put me. Next 15 minutes. 1, they are shooting at Saudi Arabia now, and I'll show you the part that nobody's explaining. 2, the receipts, the forecasters by name with dates, including the government agency that grades its own homework and gave itself a 45% error rate. 3, school, longs, shorts, and the GameStop math sitting in the oil market right now. And I'm naming 3 people in my comment section who beat every major bank in America. Let's go. Start with this morning because it's hours old and most people haven't seen it. Missiles out of Yemen fired at Saudi oil refineries. 2 got shot down over Yanbu on the Red Sea coast, and there's a detail nobody's going to tell you. The battery that knocked them down is American-made. It's sitting on Saudi soil, and it is operated by Greek soldiers. Greece has had crews in Saudi Arabia since 2021, helping guard that country's energy infrastructure. That's how international this thing already is, and we're not even at the main event. Further south, at a place called Jazan, something got through. Now let me be careful because this is a few hours old and I'd rather be right than first. Here's exactly what's known. Reuters has verified video of a large column of smoke coming from the direction of the Aramco refinery at Jazan. 2 trading sources in Asia say they were told there's some damage. Saudi Arabia has not confirmed it. Aramco has not confirmed it. What I can tell you is what that plant is. 400,000 barrels a day, about 4% of everything Aramco makes on a normal day. Now, here's the part that's bigger than one refinery, and this is the thing I want you to actually walk away with. For months, the whole story has been the Strait of Hormuz, the Persian Gulf, Iran, the tankers, and Saudi Arabia had an answer for that. They've got a pipeline that runs west across the desert from Abaqaiq and to Yabu on the Red Sea. That pipeline is how Saudi Arabia sells oil to the world without going anywhere near Iran. It was the escape hatch. An analyst named Ian Solis at Wood Mackenzie put it better than I can. He said, quote, "For months, the market treated Yanbu as the answer to Hormuz risk. The problem is Yanbu has its own choke point. And look what already happened. Saudi crude going out to Red Sea peaked at 4 million barrels a day. In March, by June, it was 20.4, down 41%. The escape hatch was already closing before this morning. So the Houthis declared a blockade on Saudi Arabia on the 20th of this month. Their spokesman said, quote, "An eye for an eye, blockade for blockade." And Andy Lepau, he runs Lepau Oil Associates. He's been doing this longer than I have. He did the arithmetic on what that blockade touches. 6.1 million barrels a day. 6.1. But here's what actually moves the price. And it is not the missiles. It's insurance. War risk cover in the southern Red Sea went from 0.3% of a ship's value to 3/4 to over 1% in a matter of days. For the southern Saudi ports, they're quoting as high 3%. And Thursday, this is the one underwriters at Lloyd's of London started preparing to cancel war risk coverage altogether for any ship with what they call a Saudi touch point, any vessel that has called at a Saudi port. Sit with that a second. You do not have to hit one Saudi oil facility to stop Saudi oil. You just have to make the boat uninsurable. A man behind a desk in London can shut in more barrels than a missile can. And Saudi Arabia is not eating it quietly this time. That was the old playbook. Get hit, stay quiet, keep pumping. Not now. Saudi jets are bombing Yemen. Hodeidah, Kairan Island, Al Jawf. Their spokesman called the tanker attacks a cowardly and reckless act and promised a response, quote, without leniency. Bridget Daikun at Lloyd's List said plainest, the situation in the Red Sea and the Strait of Hormuz has fundamentally changed, and we're never going back to what it was before. Now, you want to know why the market is still underpricing this? Because I've watched it forget before. September 2019, somebody put drones and missiles into Abqaiq, the largest crude oil processing plant on the planet Earth. 7 million barrels a day of capacity, took 5.7 million barrels a day off the map overnight. About 5% of the world's supply gone. Brent spiked about 19% intraday, biggest one-day jump on record at the time. And then, inside 2 weeks, the price was back below where it started. The World Bank wrote it up. The market looked at the largest oil facility in the world getting hit and decided within 14 days that it didn't matter. That is not a market that overreacts to Saudi risk. Folks, that is a market with amnesia. And it just did it again. 8 days ago, Brent was sitting at $86 while the number of tankers getting through Hormuz was damn near zero. 6 days later, it was over 100. On Thursday, exactly one tanker crossed the Strait of Hormuz. One all day. Okay, the experts, and I'm not name calling, I'm reading their own paperwork back to them with the dates on it, because that's what a scoreboard is for. The EIA, that's the U.S. government's energy forecasting arm, the official scorekeeper of American oil. August of last year, they published it in black and white. Brent crude will average $51 a barrel in 2026. Then in January, and this is inside the year they were forecasting, they said $56. And here's their reasoning. Quote, we expect oil prices will decline as the global oil production exceeds global oil demand. April, they moved it to 96 in 3 months. And what did April actually do? $117.29. On their own price data, first half of this year averaged 91.74. They said 51, it printed 92. Now here's my favorite part, and I promise you this is real. The EIA grades itself. They published a document comparing their old forecast to what actually happened, and their own numbers across almost 30 years for how far off they've been on the price of crude oil. 45.6%. 45% average error. That's them. That's their math on themselves. And this year's edition of that report, they took the air tables out. Paris, the IEA 2 years ago, every single one of their scenarios showed oil demand peaking before 2030, and it was the headline, all fossil fuels peak before 2030. Last November, they quietly brought back a scenario they'd shelved since 2020, and one where oil demand never peaks at all and climbs to 113 million barrels a day by 2050. They didn't retract anything, they just reopened the door. And a fallen named Cyril Chauvin wrote the line of the year about all of this back in February before the shooting started. He said the widely predicted 2026 oil glut just isn't showing up in the physical market. And then markets clear in a tank farms and on tanker decks, not in spreadsheets. Put that on a hat. Because the price forecast is a small lie. Here's the big one. They've been telling you for a decade that we are getting off this stuff and that supply keeps growing, and both halves of that are false. And the people saying so are not cranks. They are the biggest names in the business. Aman Nasser runs Saudi Aramco, biggest oil company on earth. He stood up at the big energy conference in Houston and said, quote, we should abandon the fantasy phasing out oil and gas. The head of OPEC last month launching their long-term outlook. There's no peak oil demand on the horizon. He also said the world needs $17.7 trillion of oil investment between now and 2050. Now he's OPEC. He's selling something, take it with a salt, but hold it next to this. Mark Mills testified to the United States Senate Energy and Natural Resources Committee, and he said the boom in AI data centers should, quote, finally put to rest the illusion that a digital economy will decouple economic growth from rising energy use. Every single thing that they are building to run artificial intelligence needs more energy, not less. Electricity demand from data centers jumped 17% last year. The AI ones, 50%, and the capital spending of 5 tech companies is now bigger than the entire world's investment in oil and gas production. bigger than all of it. And it isn't just fuel. The head of the IEA himself, Faith Barol, the guy running the agency that keeps writing oil's obituary, called petrochemicals one of the key blind spots in the global energy debate and said they'll have a bigger influence on future oil demand than cars, trucks, and aviation combined. Vaclav Smil, who might be the most respected energy thinker alive, put it in 4 words: cement, steel, plastics, ammonia, the 4 pillars, all of them made from fossil fuel, and without the fertilizer, you cannot feed roughly half of the people on this planet. You want the whole argument in one sentence? Oil shares of the world energy went down. The tonnage went up, and 24 set the all-time record. Share down, volume up, record year. Both things are true, and they only tell you the first one. Now the supply half, and I'll use the government's own numbers against them again because it's just satisfying. The EIA forecasts that American oil production falls this year about 100,000 barrels a day lower than last year. After 4 straight years of going up, Wood Mackenzie has global upstream investment dropping for the 2nd year in a row, and U.S. shale oil declining 200,000 barrels a day this year, which they point out would be the first contraction we've ever had without a price crash. And the man who runs Diamondback Energy, K.S. Van Hoff, said the quiet part out loud. There's only so much Tier 1 rock. That's the good acreage. It is not infinite. And we drilled the best of it first. That's not doom. That's just geology. And the shock absorber is gone. Repeating Energy figures the spare production capacity this world has sitting in reserve right now is effectively zero. In the Suez Crisis in 1956, it was around 35%. Meanwhile, Cushing, Oklahoma, the delivery point for American oil, is at 19.4 million barrels, and the government's own minimum operating level is about 20 million. We're below tank bottoms. The EIA explains what that means better than I could. Below tank bottoms, the pumps lose suction and operations stop. In every barrel of crude in this country, commercial plus the strategic reserve, 723 million, lowest since 1984. Ronald Reagan was president. Quick, because a lot of you are new this week. What I actually do out here, I don't trade paper barrels, I buy the real thing. Back at the office, I've got servers grinding through America's entire drilling record, over 4 million wells back to 1864. I call it Kingdom Scout. Every day, it regrades every actively drilled oil country in America, 220 of them, 39 earn an A. Under current tax law, you can own a direct piece of wells like that, deductible up to 100% against your income, aiming at a monthly check off real production instead of mailing it to Washington. Put it in the ground, talk to your tax advisor, links in the description. Now the 3 of you who beat Wall Street. Last Friday, I asked you to put in your Labor Day oil price in the comments, and I said the closest gets named on this show. I read every one of them. 22 of you put up a real number. 19 of you said $93 or higher. Exactly 1 went under 90. Now, hold that against the pros. CITI sell the rally $60 oil, Morgan Stanley $75, the United States government $51. The comments section of this show was more bullish than every major bank in America. And right now, the comment section is winning. That's not me buttering you up. That's the tape. Wide cut sawmill. You moved your number at 93 and the West Texas printed 93 and changed on Thursday. Sir, if this thing closed today, you win it. You called it to the dollar. Paul Joseph, you didn't give me a number. You gave me the shape. You said it rips well before Labor Day and then drifts back toward 90 by the holiday. Look at the chart. Ripped to 93 and Friday it closed at 89.31. That's the only path call on the board, and right now it's the smartest comment on my channel. And Kukunusa, Sam, 111.30, the most liked prediction on the video, but it's not the number, it's what you wrote beside it. That you don't see much hope of reasonable compromise. You wrote that a week before Iran turned down a ceasefire. But it's not the number, it's what you wrote beside it. that you don't see much hope of reasonable compromise. You wrote that a week before Iran turned down a ceasefire. Nobody wins till Labor Day, September 17th. New folks get a number up, first one's locked, and Nick B out of the UK, who came at my whole thesis and was right about the mechanism. I want more of that, not less. All right, pull up a tailgate. I promised a school, and there's now a whiteboard for 300 miles. Shorting. When a fund shorts oil, they're selling barrels they do not own. Borrow the contract, sell it high, buy it back cheaper, pocket the difference. Perfectly legal. Works great, right up until the price goes up instead of down. Because here's the thing about being short. You don't get to walk away. The only way out of a short is to buy. And when a whole crowd of them has to buy at once, their own buying shoves the price up, which traps the next guy who also has to buy. That's a squeeze. That's an entire machine. Now, GameStop, Keith Gill, Roaring Kitty, everybody thinks he won because he bought a stock and got lucky. No, sir. He won because he counted. He counted the shares that actually existed. He counted the claims the shorts had written against them. And he worked out that the paper had promised more than the real world could deliver. When the buying started, they had to buy back shares that basically weren't there. Melvin Capital, big, sophisticated professional, gone. He didn't outmodel Wall Street. He counted what was real. So count with me. There are two prices for oil. There's the screen price, futures, paper, and bet on a month that hasn't happened yet. And there's the physical price, what an actual refinery pays for an actual boatload, with today's war insurance and today's freight baked in. Right now, shipping crude from the Gulf in China costs $77.96 on a ton. The 5-year average is $18.91. 4 times the insurance on one big tanker through 3 runs, about $21 million. $21 million. For one trip, the paper has not caught up to the world. And all that American paper points at the one physical place, Cushing, Oklahoma. The tank farm I just told you is below tank bottoms. More claims than barrels. Where have you heard that before? Now, the newest piece printed last night. The Brent short's biggest bearish bet in a decade already got carried out. Bought back over 100,000 contracts in 1 week. And that covering is a big chunk of this rally. On the American side, in the ICE listed West Texas contract, the funds were 29,000 contracts short a week ago. Last night, they covered about a third of it, still short, just less short. And I want to be straight with you about the other one because it matters. The big New York West Texas contract, the headline, one of those funds are net long about 64,000. So don't let anybody, including me, tell you the shorts as if it's one number. Ask which contract. Here's the piece almost nobody's saying out loud, and it's the best news in the whole episode. Everybody's about to write that the bulls are crowded. Ola Hansen tracks this stuff, and back in June, the Brent bulls had collapsed to 114,000 contracts, a low for the year, down from 496,000 at the peak. We're at 169 now. That is not crowded. That is a market that already got scared out, which means the money that would panic already panicked. There's dry powder, not a crowd standing on a ledge. And the honest counterweight, because this show grades itself. Friday, one headline, Pakistan pushed by China exploring restarting talks between the U.S. and Iran, and crude dropped 4% in a day. One headline, 4%. So if a real piece lands, a real one, not a press release, this thing falls hard and fast. I'll stand right here and grade it. But remember what the headline actually said. The precondition was stop attacking Saudi Arabia. Hours later, Jazan was on fire. Paper melts, molecules don't. Scoreboard, I don't erase, I grade, and this week's got both colors on it. The big one, 2 Fridays ago with oil at 76.80, I put on the board that Brent prints 90 before Labor Day. Thursday it settled $100.68. 1. Closed 7 weeks early, and the house rule stands. The call was the touch, not the destination. It's back to 97.8 as of Friday, and that's fine. Now, the one I'm losing because you can't trust the wins if I hide the losses. I've got a call out that America's crude tanks drop under 400 million barrels by Labor Day. This week, they went the wrong way. Built 2 million, 411.7. Behind place, thesis intact, call behind, graded again Wednesday. Cushing under 25 million, 19.4. That one's comfortable. Iraq's only working route to the Mediterranean while the Gulf is a shooting gallery expires Monday. Monday, Turkey's energy minister said on July 10th it was at the final stage and they'd sign in days. That was 15 days ago and nobody has signed anything. 250,000 barrels a day riding on a handshake, and I have not heard one person on television mention it. In OPEC's August barrels, paper or real paper, they voted themselves 108,000 a day on paper. That same week, drones shut Kazakhstan's export terminal and cut their production roughly in half. The quota sheet is not the tanker. New call, number 7, dated today. Everything I just showed you about Saudi Arabia, the refinery, the blockade, the insurance, none of it is in the price. It all happened after Friday's close, and nobody has published a number for how much war premium is in a barrel of oil right now, so I'm not going to make one up. Here's what I'll do instead. Standard Chartered said this week that the Middle East is now a 2 choke point problem, and the cost of moving barrels is likely to go up while the risk lasts. I agree, and I'll put a number on it that you can grade me on. Brent settles above $110 before Labor Day. That prints every single day. If I'm wrong, you'll hear it from me first. So here's your week. They said $51 oil, it printed 92. They said too much supply, tanks are the emptiest since Reagan. They said Saudi Arabia was the safe one. Saudi Arabia is burning this morning. And they've been telling you for 10 years the world is done with oil, while the world quietly used more of it than any year in history. I'm not asking you to be angry about it. I'm asking you to keep the receipts, like I do, and grade everybody, including me. One word in the comments tonight, squeeze, so I know the army showed up. Because a recording from a phone on a dirt road needs you more than usual. And send this to a friend who owned GameStop and doesn't know the same math is sitting in oil right now. Next Friday, Wednesday's tank numbers, the verdict on that Iraq treaty. OPEC meets August 2nd, and the Fed meets Wednesday with a real chance they raise rates because of the price of oil. Think about what that means for your house payment. From Elise Road, somewhere in the oil country, I'm Sean Pruitt. Paper melts, molecules don't. See you Friday.